Global financial markets are closely watching an unusual and rapid surge in silver prices that has unfolded over the past several trading sessions. Analysts say the speed and intensity of the move have raised serious questions about stability in the precious metals market and whether long-standing pricing mechanisms are beginning to fail. Silver has experienced a sharp upward move in a very short period of time, a development that market observers describe as highly abnormal. Historically, silver is known for volatility, but moves of this magnitude over just a few days are rare and often associated with deeper structural stress rather than routine trading activity. According to market analysts, such rapid acceleration typically reflects institutional behavior rather than retail speculation. Large financial players, including banks, hedge funds, and commodity traders, appear to be repositioning aggressively. This has fueled speculation that institutions may be rushing to secure physical supply or unwind positions established during years of suppressed pricing. At the center of the concern is supply. Multiple reports indicate that available physical silver inventories are tightening, particularly in industrial and investment-grade forms. Silver is not only a monetary metal, but also a critical industrial input used in electronics, renewable energy, and defense technologies. When physical supply becomes constrained, price pressure can escalate quickly. Market veterans note that when price movement shifts from gradual increases to sudden multi-day surges, it often signals a transition from controlled trading environments to panic-driven price discovery. In such conditions, traditional pricing models break down and momentum replaces strategy. This has led to renewed scrutiny of the paper silver market, where large volumes of contracts are traded without corresponding physical delivery. Critics argue that for years, paper trading has masked true supply and demand dynamics. If confidence in that system erodes, prices can disconnect rapidly from historical norms. Some analysts now suggest that higher price targets, once considered speculative, are being re-evaluated under new assumptions. The argument is not based on enthusiasm, but on arithmetic. If demand continues to rise while physical supply remains limited, price discovery may continue upward until balance is restored. Importantly, financial experts warn that the implications extend beyond silver investors. Precious metals often act as early warning indicators for broader monetary stress. Rapid gains can reflect declining confidence in fiat currencies, rising inflation expectations, or institutional concern over monetary policy sustainability. For savers and investors holding cash or traditional assets, this shift may signal erosion in purchasing power rather than an isolated commodity event. Historically, when metals move sharply, it coincides with reassessments of risk across global markets. While it remains too early to confirm whether the current move represents a temporary shock or the beginning of a longer-term revaluation, analysts agree on one point. This is not typical market behavior. The velocity itself is the signal. Regulators, institutions, and investors are now watching closely. If the surge continues, it may mark a decisive moment where long-controlled pricing mechanisms give way to open market pressure driven by real-world supply constraints. Market analysts emphasize that what makes this silver surge especially concerning is not just the direction of the move, but its speed. In most stable markets, price discovery unfolds gradually as buyers and sellers adjust expectations. Sudden vertical movement over consecutive sessions suggests that normal liquidity conditions may be breaking down. When sellers step back and buyers compete aggressively for limited supply, prices can reprise violently. Several commodity strategists point out that silver's dual role magnifies this effect. Unlike gold, which is primarily held as a store of value, silver is consumed by industry. Once industrial demand meets investor demand during periods of financial uncertainty, supply stress becomes more difficult to manage. Mines cannot increase output quickly, and above-ground inventories are finite. This creates a feedback loop where rising prices attract more buyers while simultaneously discouraging sellers. Institutional behavior during such phases is particularly revealing. Large financial entities tend to move early and quietly when risks emerge. Rapid price action often indicates that these players are no longer comfortable maintaining exposure through derivative positions alone. Instead, They may seek direct access to physical metal or attempt to exit positions that depend on stable, liquid markets. Observers note that similar patterns have appeared during past periods of financial stress, when commodities began moving independently of broader equity markets. In those moments, metals acted less like tradable assets and more like monetary barometers, reflecting underlying concern about currency stability and debt sustainability. The discussion has also reignited debate over the structure of modern commodity markets. Critics argue that the dominance of leveraged financial instruments has allowed prices to remain disconnected from physical realities for extended periods. When confidence in that structure weakens, even briefly, the correction can be abrupt. Prices do not adjust incrementally. They leap toward levels where supply and demand finally align. Some analysts caution against assuming an immediate endpoint. Panic-driven markets rarely stop at neat or familiar price levels. Instead, they tend to overshoot before stabilizing. This does not guarantee continuous gains, but it does increase volatility and uncertainty across related markets, including currencies, bonds, and equities. For policymakers, the development presents an additional challenge. Rapid increases in precious metals prices often complicate efforts to manage inflation expectations. When investors interpret such moves as signals of monetary stress, confidence in traditional policy tools can weaken further. Meanwhile, retail investors and ordinary savers are increasingly drawn into the conversation. Even those without direct exposure to silver may feel indirect effects through currency depreciation, rising costs of goods, or broader financial instability. Historically, shifts in metals markets have preceded larger economic adjustments rather than followed them. Financial institutions are now reassessing risk models built on assumptions of deep liquidity and orderly markets. If physical constraints continue to dominate price behavior, those assumptions may need revision. As markets digest these developments, one conclusion is becoming harder to dismiss. The recent surge is not simply a speculative episode. It reflects deeper tension between financial structures and physical reality. Whether this moment marks a temporary disruption or the beginning of a more profound revaluation will depend on how supply, confidence, and institutional behavior evolve in the days ahead. For now, the pace of the move itself remains the most important signal, and one that global markets cannot afford to ignore.